Founder-led businesses are often some of the strongest companies in the market, okay? They're built on relationships and resilience and years of hard decisions that don't always show up on financial statements. But when acquisition partners evaluate founder-led businesses, there are certain patterns that actually raise concerns, okay? Now, it's not because the business isn't successful, but it's because buyers are trying to understand risk after the transition. Okay. So in this video, I want to walk you through the most common red flags that buyers see in founder-led companies, why these issues matters from an acquisition perspective, and how many of them can be addressed long before any transaction is even considered. Hey everyone, my name is Anthony Hitch, founder of Quantum Advisory Group. It is such an honor and a pleasure to serve you. If you enjoy content such as this, like, share, and subscribe. Without further ado, let's go ahead and get into the video. So, the most common red flag is owner dependency. Let's just sit right there for a minute. The most common red flag is owner dependency. In many founder-led businesses, the owner is the primary decision maker, the key relationship holder, and sometimes the person solving all of the problems across every single department that there is, okay? Right? So from an operational standpoint, this often works very well, right? The business grows because the founder is deeply involved, okay? But from a buyer's perspective, the question becomes simple. What happens when the owner steps back? If revenue, customer relationships, or operational knowledge are concentrated, I would say, on one person, the perceived risk actually increases, not because the business is weak, but because continuity becomes uncertain. All right. Buyers want to see that the business can continue performing even as leadership begins to evolve. Another common issue is undocumented processes. Many successful businesses operate on experience rather than documentation. The team knows how to do, or the team knows, I would say, what to do. And it's because they've already done it that way, right? And the challenge is that buyers evaluate scalability and transition risk. They want to understand how work gets done, how decisions are made, and whether new leadership could step in without disrupting that, okay? When systems exist only in people's heads, it creates uncertainty. Clear processes, okay, don't just make operations easier. They make the business transferable, okay? Now, I want to pivot towards customer concentration here. So customer concentration is another area buyers examine very closely, all right? If a large percentage of revenue comes from one or two clients, the business may still be highly profitable, but the risk profile changes significantly, okay? Acquisition partners look at what happens if one relationship changes, okay? If they're in the process of renegotiations, or let's just say that the owner disappears, okay, or the relationship kind of dwindles, right? Even strong companies can see valuation pressure if revenue isn't diversified, simply because future performance becomes harder to predict. This doesn't mean large customers are bad. No, it just means that balance is more important. In founder-led businesses, financial decisions are often practical rather than structure. Expenses may run through the business for convenience. Compensation may not reflect market norms. Reporting may focus more on cash flow than formal analysis. None of this is unusual, but buyers need clarity, okay? They want clean financial visibility so they can understand true operating performance and forecast future results with confidence. The clearer the financial picture, okay, the easier it is for buyers to move forward in their decision. Now, the final red flag is less technical, but more cultural, right? So let me explain. Sometimes businesses become successful doing things a certain way, and change feels unnecessary, right? But acquisition partners are typically looking for growth opportunities. They want to see leadership that's open to evolution, new systems, or expansion strategies. When a business appears resistant to change, buyers may worry that growth will stall after the acquisition. Okay? Adaptability signals future potential. The important thing to understand is that these red flags don't mean a business is not attractive. That's not what this means. In fact, most founder-led companies have one or more of these characteristics, right? But what does matter is awareness, okay? What matters is awareness. The owners who understand how buyers think early have the ability to strengthen their businesses long before any acquisition conversations happen. And often addressing these areas doesn't just improve acquisition interest, okay? It in fact improves the business itself, right? In the next video, we're going to talk about how owners can prepare for acquisition without deciding to sell, and why preparation is really about creating flexibility rather than forcing an outcome. My name is Anthony Hitch, founder of Quantum Advisory Group. If you enjoy content such as this, do us a favor here at QAG, like, share, and subscribe. It is such an honor to serve you. Thank you so much. Take care, and be sure to look out for the next video.